Hello, welcome back to another episode of Master Trading with Jeff Clark. It's really great to
Is that
see
what
you,
we're calling
Jeff.
it? Master trading? All right. I'll go with it.
Excellent.
Good to see you too, Rachel.
We have a brand new YouTube channel that we're just working on getting set up, which is very exciting. And this is our 6th episode, which means we've been doing this for a half a year. So
And it feels like half a year.
a lot has happened this year. I mean, I can't even
Yeah.
explain it, but we are super thrilled to be doing this for you guys. We've had a lot of really positive subscriber feedback, so please keep letting us know your thoughts at feedback@jeffclarktrader.com because we love to hear from you. Send in your questions, thoughts, concerns, what you'd like us to talk about because we love to address that for you. So I guess we'll start with, well, to me, the elephant in the room, yesterday's Fed meeting.
Mm-hmm.
And tell us a little bit about what happened and what that might mean for the next year.
Well, like every other Fed meeting, there wasn't anything shocking that came out of it. You know, the Fed dropped short-term rates by a quarter point. Everybody had already anticipated it. Everybody figured there'd be 2 dissenters, and you'd have that one gentleman who wants 50 basis points. So they cut him by a quarter. But what was surprising was a comment that he made maybe 3/4 of the way through, where he talked about, and he was very careful in the statement, saying this isn't quantitative easing, but we're going to be buying Treasury bills. So what the Fed's going to be doing is buying roughly about $40 billion of Treasury bills every month for the next several months.
So where are they getting that money?
Well,
if it's not quantitative
well,
easing?
first, before we get to that, the purpose of it, as Chairman Powell stated, is to relieve some of the liquidity pressures on the banks. And that's important to understand because, you know, the Fed doesn't work for us. The Fed works for the banks. So that's important to understand. So whatever they do ultimately is to benefit the banks. Collaterally, maybe it benefits us, but most of the time it's the direct benefit is to the banks. So whenever the Fed is injecting liquidity, my assumption is that they see something happening or they project something might occur that causes some stress in the bank, so they need to get ahead of it. So that's the purpose of that type of an announcement. Now, where they get the money from, well, you know, essentially, as Ben Bernanke said, there's a button on his desk. He can press at any time, and it generates liquidity. They print the money, and then they go into the market, and they provide liquidity in the market. Ultimately, anytime you increase the money supply, that's inflationary. That's the definition of inflation is increasing the money supply. So ultimately, that has the effect of raising demand, raising prices, because more money is chasing fewer goods. In the short term, that's asset positive. So the market saw that as a bullish statement because, oh, money's coming in. That takes some of the pressure off the Treasury. The Treasury needs to issue longer term bonds. Well, they don't have to issue so much in longer term bonds if the Fed is buying the short term bills. So rather than issuing Treasury notes at 10%, not quite that high. Rather than issuing 10-year notes at 4.15% or 4.2%, wherever it is these days, or 30-year notes at 4.7%, they can issue Treasury bills that the Fed will buy at 3.5%, which is the new rate. So that takes some of the pressure off the bond market. And if you've watched the bond market the past 6 weeks, bonds have been selling off. Yields have been going up, bond prices have been falling. And we've noted it. That ultimately has some pressure in the market. So it's going to displace some money, and it creates financial pressure in the system. So the Fed did everything right yesterday. They lowered the interest rates as everybody expected them to do, and they showed that, hey, we understand there's some stress in the bond market, so we're going to try to ease that. So it's no surprise why stocks rallied. My concern from here, same concern I've had for months, valuations are high, sentiment is high, expectations are high, everything's high, there's nothing cheap. So when there's nothing cheap, I don't want to go chasing the performers. Having said all of that, there is a large swath of stocks that are trading in single-digit price earnings multiples. They're out of favor, they're unloved. So there are bargain opportunities in the market, and I think we can take advantage of that. But if you're looking to chase some of the tech stocks, chase some of the high flyers, you know, let Oracle's earnings announcements be a pretty good lesson. You know, that Oracle was $350 a share 2 months ago. Today it's going to open around $190. And that's, Oracle. It's tech giant. It's AI. It's all of the wonderful things everybody's talking about. But the reality of the situation is it really had no business being $350 a share. It doesn't justify it at 190. I don't know. It still seems a little expensive to me. It's trading 32 times earnings, something like that. So it's hard to say. But once you push that sector out of the way, there are bargain opportunities in the market that you can take advantage of right now.
That was an excellent answer.
That was a long-winded answer, so hopefully you stayed with it.
I think that those are explanations that our readers really need, and I think you make it so easy to follow those statements, which is really, really helpful, because a lot of those financial analysts just talk way above people's heads, and that is the point. So you don't actually know what's going on under the hood.
You're not going to get a lot of 5-syllable words out of me. That's just, I'm not that smart.
Oh, please. But we've talked about this in Market Minute, and if you haven't subscribed to it, that's our free e-letter. It's fabulous. And we talk about, well, Jeff talks about in about very, very short terms what's going to happen in the market, and it's easy to understand, just like he always is. So we've talked a lot about, like you said, the bond market and the yield curve. And so is there anything that you're seeing there that might have some parallels to some other scary points?
Yeah, you know the answer to that. I've been harping on this all year, and much to my demise, because I haven't participated fully in the market, because I keep seeing this big giant rain cloud in the distance, so I'm always carrying an umbrella. And that is a little bit of a problem when everybody else is dancing on the beach. I'm tuckered down in my bunker. But the yield curve is an issue. The yield curve, as you all know, we pointed this out many times, is the yield curve was inverted for almost 2 years. Longest time it's ever been inverted. And inversion in the yield curve basically means short-term interest rates are higher than long-term interest rates. That's abnormal. It's usually the other way around. The longer you go out in time, the higher the rate of interest you have to pay for that particular type of a loan, or the higher the rate of interest you get on that investment. So yield curve is usually upward sloping. Longer out in time, the higher the yield. We were inverted, meaning negative, for almost 2 years. And only back in September did we go back into positive territory. And now it's starting to accelerate. And I don't have a chart of it with me right here, but you can pull up a chart of the yield curve and you can see how it's starting to accelerate. When you look at previous times where this has happened, it was 2007. Actually, the last time was 2020. Then it was 2007, and then it was 2001, and then it was 1990. And if you remember, if you're old enough to remember all those times, you're not, I am. If you're old enough to remember all of those were times that came right before a particularly difficult time in the economy. We had recessions that occurred right after that, and usually a very poor period of time to own stocks. Not all stocks, which is why, I'll go back to the statement I made before. There are a lot of stocks that are cheap right now that I think will get some love once the love comes out of the technology and the AI sectors. Those will start to perform. So I'm looking forward to next year, because I think this whole thing with the yield curve, as it accelerates, which means either short-term rates have to go lower or long-term rates have to go higher, or some combination of the two. And we're seeing that acceleration right now, partly because the Fed just lowered rates, and partly because long-term bonds have been selling off. So you're getting that effect right now. And that is predictive of potential economic turmoil. Doesn't guarantee we get it, but it's happened only 4 times in my lifetime. This will be the 5th. And all the previous 4 times, we were followed by an economic recession and a difficult stock market. So I do think that's coming our way, and I think it happens in 2026. I thought it would have happened in 2025, to be honest. But 2026 makes a lot of sense, because from a cycle perspective, if you follow the presidential cycle and how that correlates to the stock market, we have midterm elections, usually a difficult year for the stock market.
Tends to be a weak year.
Yeah, we've been up, 3 years in a row, double digits on the S&P, so the 4th year is usually a difficult time. So there's a lot of clouds out there that are spinning off from this. The biggest cloud, though, is that yield curve, and I think that's going to present a problem. Let me rephrase that. It's going to present an opportunity, because I think the problem exists already, but the opportunity is going to be for folks who've been conservative and who've been raising cash into this particular type of run-up in the market, and we're going to have opportunities to put that cash to work.
I was going to say, and for you, the type of market that we hopefully we'll see in 2026 is the type of market that you love to trade in because there's so many opportunities for when stocks come back up, because nothing goes down in a straight line, nothing goes up in a straight line. So that's why you had one of your best trading years ever in 2008 and also in 2022 and also 2020.
Exactly. So and a lot of folks, they look at the track record of what I've done during those particular years and they think, well, yeah, because he's bearish all the time, so he's going to do well in a bear market.
But that's not how you do well in those markets.
No, almost the best trades I made in 2008 were from the long side. What happens in bear markets is you get a lot more volatility. My type of trading, which is reversion to the mean, where you take advantage of situations where stocks are oversold, they bounce back up, stocks are overbought, they come on back down. So you take advantage of this type of move by buying at the lows and selling at the highs. That's a reversion to the mean strategy. When you have a market that we've had since April, where it's just done this, I don't do so well. Because there's not enough volatility for me to be attractive to buy into oversold conditions or short into overbought conditions. It's just this one-way market. I don't do very well in those markets. I do well in a volatile market where you have back and forth. And that used to be all the time. You get those opportunities. This year we didn't have a lot of those opportunities. I expect next year will be a very volatile market, similar to what we saw in 2000 or 2008 or even 2022. All of those were good reversion to the mean trading strategy markets. Obviously, I don't just do that, otherwise I wouldn't have any trades to make the entire year. But I look for stocks that are cheap, unloved, sentiment is poor, and they're just coming off the bottom.
Right.
That's like fishing in a small pool of water with a whole bunch of giant trout. It's easy, but you have to be patient to wait for that. This particular type of market doesn't reward patience, right? Everything moves instantly, and the stuff that hasn't performed, it's not because it's a bad company. Energy stocks haven't performed very well this year, not because it's a bad business. It's a fantastic business. It's just nobody's attracted to it. It's not sexy. Nobody's jumping over themselves to buy ExxonMobil. They will next year. Those are the type of stocks that do well next year. They're cheap, they're unloved, sentiment is poor on it, but they're good run businesses and they're trading at historically low multiples. That's what I like to buy. I like to short the stuff that is really, really expensive, but you haven't been rewarded for doing that. You get run over in this type of a market that is momentum fueled. So we haven't done a lot of short trades. And I imagine we'll probably be a little more aggressive on the short side as things start to roll over and move lower next year. What I like to do is you tell me a stock you want to buy, and I will find a way in the option market to lower your risk and increase your potential reward on that stock so that you have more upside and less downside than simply owning the stock itself. If you want to lever that and build it up to 2 or 3 times the position, that's probably okay. But when you start doing 5, 10, 20, 50 times leverage, you're going to blow up your account. One of the things that happens to a lot of folks when they first start trading options is they might get lucky. They'll do a 10 times leverage trade, and they'll buy 10 calls when really they would have only bought 100 shares of stock, and they'll be profitable. They'll make a wonderful trade, and it feels good. Oh, I won my bet. Everything's great. This is a magnificent thing to do, and they'll do that 2, 3, 4, 5 times, and maybe they're successful 2, 3, 4, 5 times. Oh, this is fantastic. And then they put it all out there, and that's usually when the market humbles you and takes it all away. And it's kind of, like I said, the gambler's mentality. It's like, you're at the craps table and the number keeps coming up. You just keep leaving all the chips out there on the table. But eventually, there's a reason casinos look the way they do. It wipes you out. And you have to avoid that gambler's mentality. If you go into the market thinking, I'm just going to, high risk, high reward, boom, boom, boom. No, you're going to lose money. I don't like to lose money. I've been through that game before. I've blown up my account a couple of times when I was younger. I don't want to do that again. And I don't want anybody else to do it. So try to learn a little bit from how I trade. And again, it's really look at options as a way to reduce your risk and increase your reward at the same time. So tell me what stock you want to buy. I'll show you an option trade that will do that. So you're risking less money and you can make even more.
So for someone who's just starting out with options, what would be your first piece of advice? I mean, obviously besides following us.
First piece of advice, well, start small. some people say paper trade, right? Where you're just, okay, I'll make a note. I'll say I bought
That
a
doesn't
call
work
option.
for me.
Well, it doesn't work because you're not emotionally
invested.
involved in it,
Yeah.
in it, right? When you have money on the line, you are emotionally involved. It's like, you gamble on the Super Bowl, right? You're emotionally involved. You're more interested in the game when you do something like that. When you're paper trading options, it's really, okay, I'm out, I'm down 50%, I'll take the loss, or I'm up 100%, I'll take the gain, and whatever. But when you're in the ditch, in the trenches, when you're actually trading with real money and you've doubled your money and you've got to make a choice, do I take it off the table now? Do I take a little? Do I let some of it ride? Whatever. That's when your emotions get in. You have to understand how your emotions affect your ability to trade. And you can't do that if you're paper trading. So what I would suggest is start small. Just trade 1 or 2 contracts at a time and see how that goes, and try to get a feel for it and understand how you react to changes in the market. If you are a high-strung individual and a 5-cent move on a $2 option contract sends you over the edge, you have to understand that is your propensity, so that you have to create a strategy that allows you to profit regardless of that happening. Or you have to be in command enough of your emotions where you can intellectually step back a little bit and go, okay, my emotions are telling me to toss everything in, I'm going to back off a little bit. Or my emotions are telling me to sell everything, maybe it's time to buy. And if you can master that, then option trading becomes more of a game, and it's more fun, and it's certainly more profitable.
You talked about the options market as like a puzzle the other day, as something that you've been just working on, playing with for years and years and years, and it never gets boring because there's always something new to figure out.
Well, yeah, the market itself is a puzzle. The market itself evolves. Yeah. So a strategy that worked really well 3 months ago doesn't work so well anymore. You have to move along with it. And how else do I say that? It's just, it's this never-ending puzzle where every day I get up and it's like, okay, how am I going to solve this puzzle today? And we work a little bit towards that. And then tomorrow it's the same thing, and the next day and the next day. And I've been doing this for a long time, over 4 decades. And I can't imagine not doing it. Truly, I get up on Saturdays and Sundays and the market's not open. I'm like, what am I going to do today? So I spend a little bit of time doing chart reviews and things like that. But it's a game that never ends, and it's a game that once you've played it for a little while and you've had some success and you've had some failures, it just becomes a passion. And for me, it's definitely that. I'll be doing this forever. So.
I love how you talk about the markets. But now that you live in Miami, on Saturday, Sunday, go to the beach. Maybe get a scuba license like we talked about.
Well, there's always that opportunity. You can always, the great thing is you can take a laptop computer anywhere. And you can trade anywhere. So you could trade from the beach. You can trade from the pool on the 50th floor, or whatever you want to do.
As much as we harp on tech stocks, it is a beautiful thing what technology has brought us.
That's true.
Just to kind of close out here, so we've been talking about sectors that are going to do well in the next year, possibly. So do you want to give us a couple of those that you think, besides, was that energy?
Well, yeah, there's lots of stuff. Like I said, there's lots of stocks that I think are trading cheap right now. The energy sector, I think, is cheap. Months ago, I talked about the healthcare sector being cheap, and I think there's still some opportunity in there. Food stocks. It surprises me when I look at something like Albertsons. ACI is the symbol on that. And it's a cheap stock. It trades 8 times earnings, and it's a grocery chain, and they're doing all sorts of things to expand and increase margins. And I think that'll eventually wind up in the stock, but nobody cares about it right now. It's Albertsons. It's a grocery chain. But I think food stocks, there's some opportunity there. Some restaurant stocks have been showing up. Cable companies, this was an odd thing. I was looking at the charts of Charter Communication, CHTR, Comcast, which is CMCSA, and there was another one. I can't remember, pull it off the top of my head here. But they all three have these beautiful bottoming patterns, and they all are trading at historically low multiples. And it's a no-growth business, right? Everybody's cutting the cable, everybody's moving to...
People hate cable.
But the companies are adjusting, they're evolving, they're moving their business patterns around, they're changing the way they operate their business to adapt to what's evolving in the marketplace. And that is not being appreciated yet by the stock market, which is why these stocks are down 50, 60, 70% from their highs a couple of years ago. they all look like they've got these beautiful bottoming patterns for me. So I think 2026 will be the year of the cable companies. God, that sounds so horrible. But next year when we do this, we'll look at those cable stocks and see what's happened. And I bet a lot of them will be up 50, 60, 70%. So there's some opportunity there. I'm trying to think of other sectors that have come across my screens lately. I can't just off the top of my head do that. The payment processing companies. So PayPal, Paychecks, they all start with P. Fiserv starts with an S, silent P. Fiserv looks interesting as well. So all of these stocks have been battered. So there's some opportunity there. So like I said, there's a lot of opportunity. Find those stocks that are trading historically below their normal valuations. So if a stock typically trades 15 times earnings and it's trading 9 times earnings, find out why that is, and if it's a recoverable situation, then that's probably an opportunity.
Well, that sounds like a really high note for us to start wrapping things up. Next time we see you, we'll be in the new year, and I think we'll be in a really exciting trading environment. So, Jeff, thank you for doing these podcasts for the past 6 months. I hope we're doing for a long, long time. Again, let us know if you enjoy our content, if you want to hear other topics, questions, concerns. We'd love to hear from you. Feedback@jeffclarktrader.com. Thank you so much.
Thank you, Rachel.